Well, what's going on in the market? Why is the stock market dropping right now? Why is it crashing? The stock market is dealing with what is called a correction. Just like we have noticed in the past, a couple of big companies make up a bigger portion of the S&P 500 than ever before. When those bigger companies like Apple, Nvidia, Microsoft, Amazon, Google, Meta, Tesla, when they go up, they have a bigger impact on the market as a whole, especially the S&P 500. But also when they go down, they also bring the whole thing down with them. Let's look at those big companies' performance recently. Apple is down 2.3%. Nvidia is down about 11%. Microsoft is down about 4.5%. Amazon has dropped about 5%. Google has shed just about 7.8%. Meta or Facebook has dropped just about 10%. And Tesla has dropped by 25%. These top companies make up a huge portion of the S&P 500 as an index. Just about 35% of the S&P 500. So why does that even matter? Well, when 2% of the total companies on the S&P 500 have an impact of 35% of the performance for the index, anything that happens to those big companies have a bigger impact on the whole index as a whole. The performance or moves that those bigger companies affect the performance or the perceived performance of the other 490 plus companies that are part of the S&P 500. I am not blaming the whole decline on those companies alone. There are many other reasons why the market is dropping right now, including some unpredictability, uncertainty, some political turbulence. There are many more reasons. So should we all sell out of the S&P 500 and look for other options? Well, not really. Those big companies are a big portion of the S&P 500. They are there and they are as big as they are for a reason. Sure, some of those might be overvalued and might continue to lose some value going forward, but not all of the top companies will continue to lose or shed value as they have been. They might be hurting the performance now, but they are also responsible for some very nice gains that we have seen in the last couple of years. Now, if you do any kind of research recently about the S&P 500, you probably will come across some articles or some news about how Warren Buffett is selling out of the S&P 500. And because of this news alone, a lot of people might be wondering if they should emulate what Warren Buffett is doing and also do the same and get out of the market or at least get out of the S&P 500. Well, here's the thing. Warren Buffett has never really been a S&P 500 investor. It seems like every time that he parks money into the S&P 500, he uses that as a tool to diversify or just park his money in an asset that gives him more growth potential than just sitting in a high yield asset account. Now, keep in mind, this guy, Warren Buffett, is one of the best, if not the best, investor of our time. He has been a professional investor for his whole life, and he has a team of professionals that work with him full time to make sure that he does what he does better than anybody else. He has the resources, the know-how, and the magic Warren Buffett touch to pick individual stocks at the right time. The fact that he sold out of his position on the S&P 500 should not be considered or taken as an indicator to time the market. Remember, you and I are not Warren Buffett, and we definitely don't have the resources that he does. His total position sold was just about $50 million worth of the S&P 500, which is a lot of money for you and I, but that is not a significant portion of Warren Buffett's total assets or even his available cash. And also talking about available cash that Warren Buffett has, that's another piece of article or news that you might be coming across. Yes, he has over $300 billion in cash or cash equivalent available for trading. That is a big amount of money. But that does not mean that Warren Buffett is not investing or not invested and just sitting on the sidelines. In fact, that is about 25% of his total assets. It's like saying that you have $1,000 and you have $750 invested into the market, and just because you have $250 set aside for future opportunities or for taking advantage of a discount investment, that you are timing the market. Okay, now what do you do during these times where it seems to be so unclear what we as regular investors should be doing? Well, let me tell you what I'm doing. I am investing in a broader market ETF, things like VTI or SCHB. My pick is SCHB. These investments will have a lower impact from any individual company performance or their stock performance. Companies within this broader markets represent a much smaller percentage of the total ETF as a whole. Therefore, they have a smaller impact when those individual companies go up or down. On the same token, that also means that those broader ETFs have a lower chance of increasing in value when those bigger companies do rally up again. But at least in the meantime, you will have the peace of mind of having a more diversified portfolio and not having to deal with the risk of a few companies dragging down your whole portfolio value. You could also consider some value or dividend ETFs, things like VTV or VIG, SCHV or SCHD. These ETFs are usually made up of companies that tend to be older, well-established companies with usually lower risk. They usually provide a lower growth potential, but not always. During downtimes, a lot of investors like to park their money into these ETFs because they provide that kind of safety. So that increase in volume coming into the ETF might also translate into appreciation of the value of the ETF itself. Also, what I'm doing to protect and prepare for my investments going forward is this. My current investments and holdings will stay the same. Nothing's gonna change when it comes to that. My only change going forward will be that I will be increasing my allocation to SCHB. I'm still going to continue to invest the same amount of money that I have been investing every single month. But now more of that money will be allocated to be invested into my SCHB position. I will also be working out a way to increase my savings rate and start building available cash just in case a discount, a dip, or an opportunity presents itself in the future. I am not changing my investing plan. I believe that people should stick to the plan that they have in place regardless of how the market is doing. As long as you have a solid, achievable plan, you should be able to stick to your plan regardless of how ups and downs you will see in the market, which are completely normal swings in the market. Basically, the only change that I am doing in my personal finances is finding ways to increase my cash available for future opportunities. But my plan stays the same. Let me know in the comments below what are you doing to prepare if the market continues to decline. I recommend you watch this video next and see how these ETFs portfolio compare, and maybe you'll find the ETF that you'll be looking for and that will help you be better positioned to ride out the declines of the market. Now, don't forget to like and subscribe. See you in the next video. Let's grow together.